Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm Eric Chummy, in today for Bob Pisani. And later we'll be joined by Andrew Channon, the CEO of Procure AM. But first, vaccines may be headed our way. Winter is coming faster, though. The economy is expected to weaken significantly over the next 2 quarters before we get that vaccine and stimulus, if we get them, hopefully next year. Dave Neidig joins us now. He's CIO and Director of Research at ETF Trends. We've also got Will Rind. He's CEO and founder of Granite Shares. So, Dave, with the markets caught up in this tug of war between hopes for a spring reopening and fears of a dark, dreary COVID winter, is the rotation back into cyclicals maybe happening a little too early?
Yeah, I think it's happening quite frankly, very, very much too fast. I think there's very little chance the economy is going to be real gangbusters over the next 6 months. There's really no chance for any significant stimulus, really, frankly, probably before February. And whether that stimulus is enough to do anything but maybe keep the consumer economy alive, I think really remains to be seen. And I don't see a lot of real rosy things on the horizon until we have that broad distribution of a vaccine. And I think that's much further out than people are really counting on. I think we're talking about next summer, not just sort of a magical airdrop of vaccine in January that somehow solves all these problems. So I think the right thing for investors to do is think about what's been working during the pandemic, whether that's something like the direction work from home ETF, WFH, which obviously has gotten a lot of play, but it's been hugely volatile, right? As people see this news, they somehow think that because we get a vaccine announcement, all of a sudden we're not going to do Zoom calls anymore. That's not the way this works. I think those folks that have been winning in the COVID economy, if you will, are going to continue to win going forward.
Will, that's actually something I wanted to mention to you. It's just because we have a vaccine, like we just heard, just because we have it, it doesn't mean COVID goes away. It doesn't mean everyone's using the vaccine. Even if they get the vaccine, even if COVID goes away, it doesn't mean people are going back into the office. It doesn't mean they're moving back to the big cities that they just left. So how do you play this situation when you're really trying to play Nostradamus on a lot of factors about how people are going to behave?
Yeah, no, it's a good question. I mean, I think the simple thing is we're not out of the woods yet for all the reasons that you've just brought up. And therefore, I think one thing that we can be assured of is that there will have to be more stimulus, at the government level, both the government and, the Federal Reserve as well. And that, the upshot of all of this will be there'll be more volatility in the market. So for me, I think gold is still a good play in this particular market environment, as people look for a hedge to the market volatility that we're seeing.
Dave, I'll send it back to you. Like we know the vaccine. Oh, go ahead, Dave. Go ahead.
I was just going to say, I think the opportunity here is not to necessarily try to pick the next winner. I think we realize that's probably a bit of a fool's errand. But if you're looking to sort of think about your equity allocations over the next 6 months, I'd be looking for signs of weakness. And that doesn't mean going and buying the most beleaguered, the most beleaguered ETF and the most beleaguered sector. But if there are things like the work from home ETF or, say, online consumer ETFs, technology ETFs that we really have some pretty fundamental beliefs about why they're working and why they'll continue to work, I'd look for weakness there. I'd be very reluctant for anybody to be chasing, say, energy, because energy all of a sudden seems to be having a good day. I think the fundamentals of the economy are still very, very shaky. I think most of the good news is priced in. And I think a lot of the bad news is going to be pretty bad. And it's going to be a good quarter or two before we get some of that shaken out of the system. So the market's really good at pricing in hope. I don't think the market's been particularly good at pricing in fear and reality.
Will, I'll send it back to you. So just exactly what Dave was saying was something I wanted to mention. We already know about the stimulus and how maybe that's coming. We know about the vaccine. We know it's been a winner. We know it's been a loser. And there is a lot of hope price. And we're looking at all-time highs right here. So how do you tell a trader, an investor, okay, chase this, but don't chase that, because we already have all this news baked in, and maybe chasing weakness, there's a reason why that stuff is weak. Maybe it's never coming back.
Yeah, that's right. And I think, also with markets the way that they are, I do think that people should be thinking about the more defensive elements of the portfolio because, risk is running wild at the moment with all of the stimulus, with all the good news that we're talking about. But yet there's still a lot of risks out there. So for me, that's that's gold in the portfolio. What we also have, Eric, is an income crisis in this country that, when before COVID, getting 5% income in a portfolio was probably somewhat optimistic. But that 5% has now become 3% or lower in this particular pandemic scenario. So now you've got a situation where people are looking for income like they never have before, and there are very, very few options for them to credibly generate a high level of income in this particular environment.
You're right. I mean, income is impossible right now. It's almost basically zero. I know people, they're chasing those dividend ETFs, right? They're chasing stuff like that. And we know, yeah, you can get a high dividend because that stock is going to zero. So good luck actually getting paid out on something like that.
You really have to look past the traditional, bond ladders and dividend stocks. That's not, if you really need to generate income right now, you have to look for alternative sources. Will has a product in his lineup that does this, that looks at things like business development corps and MLPs and REITs and sort of other sort of slightly more non-traditional ways of generating income, things like preferreds. We've seen a lot of activity in things like preferreds. There have also been a lot of growth in alternative strategies that use options to manage that downside risk, whether they're the so-called buffered ETFs or funds like the nationwide retirement income ETF, NUSI, which sort of squishes the returns of the NASDAQ 100 and generates income out of that. If you need income, you've got to look past those traditional ways of thinking about it.